This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. In today's video, I'll be going over the data sets. I would generally go over the earnings, but we just have major bank earnings this week, so I'm really not going to cover that much. And I will be going over the technical analysis for the SPY for the week of January 12th, 2026. And with that said, let's go ahead and jump straight into the data. Now, we do have a lot of data this week, but it's nothing super overwhelming. It's mainly just the CPI on Tuesday and the PPI on Wednesday, but we do have a couple individual data sets that are important. Mainly the stuff that I marked is what I consider to be important, but there are some data sets in here that I didn't mark that are important, like the new home sales, the existing home sales, things like that. But quickly going over this, on Monday, we essentially just have Fed member Bostic speaking at 12:30 p.m. And at 1 p.m., we have the 3-year and 10-year Treasury auctions. We should be seeing a lower yield on both of those, but that's something we'll discuss more on tomorrow's video after we see the yields on those. Um, those have greater implications going into the rest of the week and potentially into next week. So discussing them in tomorrow's video will be better suited. Now for Tuesday, we have the weekly ADP employment change. Last week, it gave us a fairly dovish number. I still expect that to occur as we've been seeing really just cracks in the labor market. We've been seeing deterioration. We haven't been seeing a full-on collapse, but we have been seeing struggles within the labor market. And even last week's data with the JOLTS job openings showed almost a million jobs compared to the year prior. So not good. Um, especially the NFP data last week. We should be seeing that close to 150 to 180,000 for it to be only around, I believe it was 40,000 last week. It might have been 50,000, but still heavily under the number. And with what Powell has been saying, um, those numbers could be roughly negative 40 to 60,000 per reading, which would put it at negative 20K, negative 10K jobs for that reading. So not good. This ADP weekly change is very, very key because it's an automatic data processing um, data set. So it's not really configured by too many people. It's just automatic data that comes in and comes out. So I like it just because the fact that it isn't influenced by anything else. Sometimes it gives us some wonky numbers, but I do like that just because it's automated. Now at 8:30, we have all of the very, very crucial CPI data. Now this week, they are anticipating a higher reading on the CPI almost across the board from the month over month, year over year, the standard, non-core, month over month and year over year. They're expecting essentially a zero point 0.1 increase almost on all of those data sets. Now, I still disagree with that. I still think we will be seeing a cooler set of CPI, and depending on what the CPI gives us, whether it's cooler, neutral, or even hotter, then the PPI will generally follow. Not always, but generally the consumer price index and the producer price index tend to go hand in hand. At 1 p.m. on Tuesday, we have the 30-year auction. Now, this is a very large auction compared to the 10-year and 3-year. Again, the implications from that Monday auction and from the CPI dataset will be heavily weighing on what occurs during this 30-year bond auction. So keep that in mind. Now going over Wednesday at 8:30 a.m. we have the PPI data again. That will be following in suit with the CPI data very, very likely. So if it's cooler, if the PPI or if the CPI data is cooler, the PPI data will generally be cooler as well. So keep that in mind. Doesn't always work that way, but in most cases it does. At 8:30 as well, we also have the retail data. This accounts for retail control and retail sales. Both of those, it doesn't show the control, it shows the retail sales though. They're showing a slight increase for November. Based off of everything I've been hearing from November, even though Black Friday and whatnot did not do as good this year as the last few years, um, it still was okay. So can we potentially be seeing strong November data? Potentially. I think it still is weak compared to the year prior. And if most data trackers are being honest with themselves, they will track that. But I do expect that to come in weaker. Now, let's see what else. At 10 a.m., we have the retail inventories. This hasn't been super important, but we have been seeing the retail inventories slightly starting to grow again. Again, this kind of ties in with the orders we've been seeing. We've been seeing a massive declining trend in the orders from manufacturing, production, just everything across the board. So with the inventories picking up very slightly, that just means that they're barely restocking on goods. Just the very basics. So not exactly a good thing. Um, Generally you'd want to be seeing that type of data picking up quite a bit. Now at 12 p.m., we have the Fed GDP now, and a few Fed speakers. We have Bostic and Kashkari. Now, the Fed GDP came in quite elevated last time, and very likely that was due to the whole Venezuela conflict. Now, I'm not going to get into the Venezuela conflict right now, but I don't expect this GDP number to hold. It might stick for a few more readings, but extremely likely this is elevated purely due to imports. So, or the lack of imports. So keep that in mind. At 2 p.m., we have the Beige Book. Now, the Beige Book again is about a 40-page, statement where the Fed goes out to local businesses in each of the districts and kind of gets a boots on the ground approach to, are they seeing consumer weakness? Are they seeing hiring weakness? Are they starting to do layoffs? Basically, they're just getting the whole, business front of sales and everything else. So they want to see how consumers are doing, how companies are doing, and that's why I really like the Beige Book. It's probably one of the best data sources you can get just due to that. It's not edited to really hide any sort of language or anything. They go district by district, and they really detail out where they're seeing weakness, where they're seeing strength. So if you don't read the whole beige book, that's fine. They do write a summary at the beginning, or you can always copy and paste one of your chatbot AIs and get a summary that way. But I would highly suggest starting to read the beige book. It is a very good way to understand what's going on in the, United States economy. With that said, the beige book data usually doesn't cause any large moves, but if there's anything in there that's very crucial, it will carry over into Thursday's trading session. Now, for Thursday at 8:30 a.m., we have the export and import indexes. These are important, but this isn't the export and import prices. This is showing the actual indexed amounts. So this will tell us a very key set of data going into the actual GDP numbers, I believe, next week or the week prior, or the week after, I mean. At Let's see, and we also have the state manufacturing and employment data during that same time window. So a lot of data coming out at 8:30. There's really nothing for the rest of the day. There is Vice Chair Barr speaking at 9:15 a.m., but honestly, in the last few years of tracking almost every single speech he does, I have not heard him say anything important. So that's that. For Friday, very relaxed day. We just have the industrial production data and Fed member Bowman speaking at 11 a.m. So overall, a fairly relaxed week, even though we do have some very crucial data. But again, it's mainly that Tuesday and Wednesday time slot with the CPI and PPI. Now, some of the things that can shift up this week are these treasury auctions and the jobless claims. I was losing that for a second in my head. Other than that, all the data sets should be pretty pretty relaxed and simple. We shouldn't be getting anything that should be pulling a wild card on us or anything else. And especially with the earnings this week, just being bank earnings, it's just JPM, BNC, just some of the ones like that. So nothing major from that front. It's not like we're going to get some absurd tech earning out of the woodwork. Very, very standard week in terms of data and earnings.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
And getting into the technical analysis, as always, let's ensure our daily time frame is turned on and our moving averages and Bollinger Bands, and let's get into it. So on Friday, we had what I personally thought was going to be that upper Bollinger. Um, However, the upper Bollinger was not taken. We did have a bounce off of the 5 month moving average, and from there, generally, you're going to see a push into the upper Bollinger, which really kind of leads me into what I'm really anticipating out of the next probably 1 to 2 sessions. Um, we're getting all these moving averages and everything, and just primarily sticking to the 5 month. The 5 month will be around the 691.60. It might be around 692. It might be closer to the lower range of 691. Excuse me. However, that level is going to be very important. If we're going to have an additional 5 month test, then the market will be pulling down towards that level very, very quickly and extremely likely bouncing upward. Reason why I say that is because almost the entire session on Thursday and Friday, we were creating a cup, and now we're starting to form the handle. If we're going to have any form of downside test here, the 5 mah is right there. That's where you test the 5 mah and push up into the upper Bollinger. Now, something we need to start being aware of is that if you've been watching my content for a while, you understand that there's this, I always forget the name of it, but I kind of call it like the no man's land, where it's between this upper Bollinger but above the 5 mah. Now, when you get into these ranges, they look extremely bullish. However, they generally tend to reject that upper Bollinger push and start heavily consolidating toward the downside. Now, again, just very, very quickly, some of those moves have given us some of the more larger sell-offs. Um, here is just one very, very quick example where we were rejecting the upper Bollinger. We were not testing the 5 mah. We had a very, very, very quick 5 mah test. Started pushing up again. Once again, rejected the upper Bollinger and went all the way from the upper Bollinger to the lower Bollinger within the same trading session. So that was almost a $20 move within the same trading session. Another one was up in here where we were rejecting the upper Bollinger, started to pull down, test that 5 mah, rejected to a sell. And probably the best example of this is prior to the major sell-off in February, where we were extremely bullish in this range because we thought that this was a cup and a handle forming, getting ready to push up to the upper Bollinger again. Instead, we started to see that rejection off the upper Bollinger, but not testing of the 5 mah. And from there, had massive selling. So, am I bearish here? No, but you just have to be very, very cautious because sometimes those ranges do like to cause selling off. Now, here are some of the reasons why I don't think we're going to be selling off this week unless we get an extremely hot CPI or PPI data set. One is that our bullish structure, and I'm going to turn off the moving averages just for a second so I can show the drawings. Doesn't do a lot of justice. I want you to pay attention to this orange channel though. It's that we've been constantly getting close to the bottom of that and having massive bounces to the upside. We're not near the bottom, but we're fairly close. Um, And from that range, we've had nothing but bullish upside. And this 4-hour time frame will kind of highlight that a little better. I will turn off the Bollinger so you can see. But, going over probably the last 2 months of trading price action had bullish structure. Even though this is a bearish structure, this is expected because we expect that at the top of a cup. So expected bullish or bearish structure, pulled down, gave us our bullish structure for the breakout. Again, we anticipated a bearish structure here to create the liquidity to continue breaking out. And so far, that's kind of what we're expecting. We're expecting the push upward into that upper Bollinger and the consolidation downward into the breakout. Um, these three bars right here were the moving averages on Friday. They don't really matter right now, but I'm using them for a different video in a couple minutes here, so I do want to keep them up. Um, but going back to the upper Bollinger, going back to the moving averages, as you can see, over the last few weeks, we started to see a major consolidation within our moving averages. We had the 20 MA starting to pull above the 10 MA. We had the 5 MA pulling below the 20 MA and the 10 MA period, or for a brief period. And from there, we started to see the upward break. Now, this still looked somewhat bearish just because the moving averages were so close together. However, currently we have the 5 mile well above the 10 mile. We have the 10 mile well above the 20 mile, 20 mile well above the 50 mile, and the 200 mile is way down there. But we have thoroughly tested the 20 mile very, very consistently over the last 2 to 3 months. And again, generally you want to be testing the 20 mile about every 20 trading sessions. If you see it tested a lot more often than that, that's not a problem. But that can mean that there's a lot of indecisiveness going on here. Um, if you were to draw a channel right at the bottom and right at the top, there's a very, very heavy consolidation range right here. But from consolidation, that's how we get the breakout. And this is looking like we're going to get that upward breakout. If we don't see that 5 mod test almost at the open on Monday, I would highly, highly, highly anticipate that upward break. And again, the upper Bollinger is currently at 697.44. On open tomorrow, it'll very likely be around that 698.60-ish. It might be around the 699. But just remember, if we're going to have that upward move to the upper Bollinger, we will close at or above that level. We won't just tap that level and pull down. It will be a close at or above that level. If we succeed in doing that, then we can move to the day two upper Bollinger, where we generally see a higher high, and from that higher high, we get the downward consolidation back to the 5 mile. Now, if we test the 5 mile tomorrow, we do need to pay attention to the VVIX, and this is kind of one of the reasons why I was saying that I don't believe the market is bearish right now because the VVIX is pulled down very, very, very heavily. Now, this can mean that because it's pulled down, it's getting ready to launch back up again. Sometimes that tends to be how the VIX works. But remember, this is a little different than the VIX. This is the VVIX. This tracks the future equity insurance, not the calls being written on the actual VIX for a hedge. This tracks the actual futures insurance. So it is, in my opinion, a better tool. Now, again, looking at our kind of safety levels here, I know it's not very clear to see. Let's go over the 4 hour. That'll make it a little easier. Again, being below the 92 suggests that there's going to be buying on the SPY. We saw that last week where we were starting to be between these two ranges, but we had that massive pull down, and from that massive pull down, that gave me a ton of conviction to buy the upside, and we saw that exactly within the SPY. We had all-time highs. Now, again, as long as we're in this green zone, then that means that extremely, extremely likely you're going to be seeing buying on the SPY because that means that absolutely nobody is hedging their equities or their futures insurance. If you start entering this yellow range, that's kind of the caution range. That's some people are starting to hedge, some people are continuing to buy. If we pull into the red or above, that means, danger zone, people are starting to sell. So when we get to the 5 mile, it's very important to look at the VVIX and see, are we starting to continue to enter the buying range? Are we seeing this pull down? Or are we seeing this pull up where potentially we're going to reject that 5 mile? If we have a 5 mile rejection, and let me go back to the SPY. If we have a 5 mile rejection, it will be pulling down extremely, extremely likely all the way to the 20 mile because again, the 20 mile, the 10 mile, and the 5 mile are still very close together. If we have extreme selling from this range, it can break the moving or the bullish moving averages we have set here very, very quickly because again, the 5 mile moves very fast. It only takes 5 days to catch up to wherever that level is going to be at, or wherever the price action's at. Now, if we pull down, if we have a rejection from the 5 mile, if we start selling into the 20 mile, then within 2 to 3 sessions, we'd have the 5 mile pulling not just below the 10 mile, but below the 20 mile as well. And then all of a sudden, everything's bearish again. So, continuing our structures, the bullish upside looks extremely, extremely strong right now. Just going over all of our different instruments we've been looking at, going over, let's take a look at Bitcoin, because generally Bitcoin's a good indicator for this as well. If we start seeing closing back to the upside, then that will be a very bullish indicator that there's probably going to be weight put into equities. Very, very quickly looking over silver. I just want to take a look at this for the sake of everybody. Had a very nice support test in here. However, this is looking bullish. This is looking very bullish, actually. So my primary concern with precious metals right now, and I'm going to start with at least silver, is that you see this 20 mile range. This has not been tested in quite a while. The last test was on the 11th of November. So again, that's roughly 2 months ago. That's telling us extremely, extremely likely that we're getting very close to seeing some sort of price action to pull us to the downside. Now, with the moving averages have been bullish ever since that breakout in, October, November. Um, we're still seeing cups closing in here. And not just cups closing, we're seeing cups with handles. So if we push back up to that 75, it looks extremely likely that we're pushing back up to the upper Bollinger again. And the upper Bollinger is currently at 75.69. So that gives you a push very, very likely to the 77 range this week. Again, just continue watching the ADL. Continue watching for weakness within the 5 mile. If we see the price starting to pull below that 5 mile, that's starting to tell you that very, very, very likely we will be seeing a sell-off. Now, I'm not seeing any major signals of that happening just yet. Um, what I would truly expect is to push up to the upper Bollinger and then to sell off. But again, just be very cautious. When you see stocks where they haven't tested that 20 mile in quite a while, that becomes a very, very large warning sign because that tells you that they're pushed well above their levels. And that doesn't mean that silver won't go back up to this range. Silver could be worth far more, but you still have to test supports. You still have to have selling to have continued buying liquidity. So keep that in mind. As for gold, take out the drawings. That looks very good too for an upper Bollinger push. Now, this one is a little bit deceptive. However, we did have the rejection of the head and shoulders here. As you can see, the head, left shoulder, right shoulder, that was rejected to the upside. And now we're starting to close this cup at the 418. And this is on the gold ETF, the GLD. So extremely likely we see not just that 418, but pushing up towards that 420 range. Um, because again, once you build a cup, you have to build the top of the cup or of the handle, and the top of a handle generally consists of a bear structure to pull downward to create the bottom of the handle to push back up again. So be aware of that, but precious metals do look very good right now. Very quickly over treasuries. What do we see here? Again, a lot of the same stuff that we have been seeing. And let me make this not a mess here. Before I make it not a mess, I want everyone to look at the red circles. Okay. The red circles were each time we hit the lower Bollinger, and each time we've hit those lower Bollingers, we've started to see buying to the upside. Now, granted, our buying is tapered in here. Okay. It's not exactly the type of buying we've seen in all of those other downside the bottom Bollinger moves. However, we still have this extremely strong bullish structure here. We have I'm gonna turn off the Bollingers, but we have the top of this bearish handle built, and very potentially we're starting to build the support bottom of this handle. If the support bottom starts to build back upward, if a lot of this news that we've been hearing with the MBSs and everything, and I'll go over that hopefully in tomorrow's video if I don't forget, but a lot of the news with the MBSs and everything is going to be pushing a lot of money into treasury-based vehicles. So are we going to be seeing long end bonds starting to be purchased? Quite possibly. We're seeing MBSs starting to be purchased and at least 200 billion of government liquidity being flown or pushed straight into MBSs, which very likely means that following other spreads, everything else, we're going to follow suit. So again, everyone makes it a meme, but I'm still bullish on TLT. This March window is looking extremely good. Um, so far, I'm not going to change that window. Um, if we see further downside from this point, though, then we'll consider going out further, or even potentially readjusting, just the analysis of TLT in general. But we've been seeing a lot of struggles, but through all the struggles, I want you to look at the ADL. And again, the ADL is like a bank account. If you see this going up, money is flowing in. If you see it going down, money is leaving. During this massive cup and handle, you see it right within the money flow as well, is that funds are entering back into TLT. It's not as weak as everybody's suggesting it is. So again, I am bullish on TLT. I don't think that the CPI or PPI this week are going to cause any massive catalyst for TLT, but I think that the pressure from the labor market and everything is getting very close to pushing that range to where the long end treasuries are going to have to start being purchased again. So okay, that's going to be today's video. Thank you all for watching, and I will talk to you in tomorrow's video. I will be putting out a video very shortly on scalping, so I hope you look forward to that. With that said, I am bullish on SPY. I am bullish on precious metals right now. Just be very cautious of this potential upper Bollinger rejection, because if we reject that, the downside could be pretty gnarly. But again, we're seeing money flowing into the SPY, we're seeing money flowing into QQQ, we're seeing all the signals that we want to see. A lot of bull structure in here, looking like it wants to push back up to the all-time highs. So it looks very good for this week for the bulls. Um, Again, I don't really start getting bearish until we start hitting that upper Bollinger range because that's when you start to short. If we're not there yet, if the moving averages are bullish, then I'm going to continue writing the direction and that will be up. So yeah, take care everybody. Thank you again for watching. Thank you all for supporting me. Um, while I've been trying to get better throughout the last year and everything. Thank you, thank you, thank you, and I look forward to the rest of 2026 together. See you in tomorrow's video.